Selling the same business for the same price can leave you $50,000 poorer at 60 than at 55. Same buyer, same number, same paperwork. In the next 10 minutes, you'll know which of the three ages, 55, 60, or 65, actually leaves you richer once taxes, healthcare, and Medicare are all stacked together. And the answer isn't 55 or 65. The most expensive year to sell is the one most owners default to, because every hidden cost overlaps inside the same calendar. You've built it for 20 years. The number on the term sheet is finally real. The question you keep asking yourself isn't whether to sell. It's when. Sell earlier and you keep more of the runway, but you give up years of growth on the business itself. Sell later and the valuation might be bigger, but the tax bill, the healthcare premiums, and a Medicare rule called IRMAA can quietly eat the difference. Here's the part nobody tells you. The same $2 million sale produces three different bottom line numbers at 55, 60, and 65. It's not because the buyer pays less, it's because the calendar around the sale changes what the federal government, the insurance market, and Medicare each take from you on the way out. We're going to walk through the same sale at all three ages and show you the math, the hidden costs, and the one window most owners step into without knowing what it costs. Let's set up the example. The business sells for $2 million. Your cost basis is $200,000. That leaves $1.8 million in long-term capital gain. At the federal level, that gain hits the 20% bracket. On top of that, a high-income surcharge called the net investment income tax adds 3.8%. So roughly 24% of the gain goes to federal tax alone. That's about $430,000. If you live in California or New York, state tax adds another 9 to 13%. Plan on roughly $600,000 to $660,000 in total tax on that sale. You walk away with somewhere around $1.3 to $1.4 million in cash. So far, the math is the same at any age. Now here's where the calendar starts shaping the outcome. The first lever is healthcare. If you're under 65, Medicare hasn't started yet. You're buying insurance on the marketplace. The marketplace subsidy disappears for anyone whose income clears 400% of the federal poverty level. In the year you sell, your reported income jumps by more than $1 million. The subsidy is gone for that year, guaranteed. The question is, how many years come after the sale year before Medicare picks you up? Sell at 55 and you have 10 years of insurance to buy on your own. Sell at 60 and that drops to 5. Sell at 65 and it's 1 year or 0. The second lever is Medicare itself, and most owners have never heard of it. It's called IRMAA, the Income-Related Monthly Adjustment Amount. Medicare uses your tax return from 2 years ago to set your premium today. We'll call this the 2-year echo because that's exactly what it is. A high-income year now echoes onto your Medicare premium 2 years later, and it stays elevated for at least a full year. The third lever is the Roth conversion window. Between the year your business income stops and the year required minimum distributions begin at 73, you sit in a lower tax bracket than you did when the business was running. That's the window where converting traditional retirement money into Roth cost you the least. Sell at 55 and that window is 18 years wide. Sell at 65 and it shrinks to 8. The fourth lever is Social Security. Full retirement age is 67. Claim at 62 and your benefit is permanently cut by 30%. Claim at 65 and it's cut by about 13%. Wait until 70 and it grows by 24% over what full retirement age pays. The sale itself doesn't move these numbers, but the cash from the sale changes whether you can afford to wait. It's not the buyer who decides what you walk away with, it's the calendar. Now let's walk the same sale through all three ages. Take Maria, age 55. The business sells for $2 million. She nets roughly $1.3 million after federal and state tax. She's a decade away from Medicare. Those 10 years are what I'll call the bridge years, the gap between the last day of business income and the first day of Medicare. The bridge years are where the timing math actually plays out. Because the sale year was the only high-income year, Maria can manage her reported income in years 2 through 10. She lives off the sale proceeds, runs almost no taxable income, and requalifies for marketplace subsidies. She also has 10 years to convert her traditional retirement money into Roth, a few $100,000 at a time, at the 12% bracket. Each conversion saves her roughly 12 cents on the dollar versus what required minimum distributions would cost her later. Over 10 years, that's another 60 to 80,000 in lifetime tax avoided. The 2-year echo doesn't catch her because by the time she hits Medicare at 65, her sale year is 8 years in the past. IRMAA looks at age 63 income, which is low. She pays the baseline Medicare premium. Now take David, age 60. Same sale, same 2 million, same 1.3 net. His bridge years are 5. 5 years to Medicare, but that's also 5 years of buying marketplace insurance. The sale year subsidy is gone. Years 2 through 5, he could in theory requalify for subsidies if his income drops, but here's the trap. He needs to do Roth conversions during those 5 years because the window before required minimum distributions is already short. Every conversion dollar counts against his marketplace subsidy, and when he turns 65, the 2-year echo catches him hard. Medicare looks at his income at age 63. That income includes the conversions he just did. His Medicare premium starts at the top IRMAA tier and stays there for at least a year. Add up the lost subsidies, the higher Medicare premiums, and the rushed conversion window, and David ends up roughly 40 to 80,000 behind Maria over the same 15-year stretch. Now take James, age 65, same sale, same net. Medicare started the same year. No marketplace gap to worry about, but the 2-year echo is unavoidable. The sale year income hits Medicare at 67 at the top IRMAA tier. For a married couple, that surcharge adds $5,000 to $7,000 per year, per person, for at least 1 year. James also has only 8 years to do Roth conversions before required minimum distributions start, and any conversion in those years compounds the IRMAA pressure. If he claims Social Security at 65 to free up cash flow, he locks in a permanent 13% benefit cut for the rest of his life. If he waits to 70, he loses 5 years of checks while burning down the sale proceeds faster. So, the same sale produces 3 very different lifetime outcomes. Maria wins on tax bracket arbitrage and a clean Medicare entry. David loses on healthcare and a compressed window. James loses on IRMAA and Social Security pressure. It's not your effort, it is the structure of the numbers. The instinct most owners follow is to wait. Wait for a better valuation. Wait for the right buyer. Wait until you feel ready. And that instinct often pushes them into the worst window, ages 60 to 63, where the costs overlap and there's no room left to maneuver. There are 2 updates from the last year that change this math for some owners. The first is Section 1202, Qualified Small Business Stock. If your business is a C corporation and the stock has been held long enough, you can exclude federal capital gains on up to $15 million of the sale price. Last year, that ceiling was $10 million, and the holding period used to be a strict 5 years. Under the One Big Beautiful Bill Act, signed in July of 2025, the rule shifted. 3 years gets you a 50% exclusion. 4 years gets you 75%. 5 years still gets you 100%. If you formed a C corporation after July 2025, your timing math now bends around the holding period clock as well as your age. The second is state residency. California taxes capital gains as ordinary income, up to 13.3%. Texas and Florida tax them at 0. A move that's been planned for 18 months with documented intent and a new primary residence can save you $150,000 or more on a $2 million sale. The sale year is the wrong year to suddenly become a Texan. The 2 years before are the right window. Both of these levers favor planning early. They don't reward waiting. They reward setting up the structure 2 to 5 years before you actually sign. Here's the part to take with you. The sale price you negotiate matters less than the calendar you sell into. Most owners spend 2 years on the valuation conversation and 0 hours on the timing math. They sign in the year that feels right and discover the IRMAA bill, the lost subsidy, and the compressed Roth window after the fact. That's not bad luck. That's the timing of the sale, doing the work nobody warned you about. You are not behind, and you are not stuck with whatever the calendar happens to say when the buyer is ready. You have more leverage than you think, because most of these levers move slowly. The 2-year echo on Medicare can be planned around 2 years out. The state residency clock takes 18 months. The Roth conversion ladder takes a decade if you have one. Each of those is something you set up before the sale, not after. Here's tonight's action. Pull up your most recent tax return. Find your adjusted gross income. Then look up the IRMAA brackets for 2 years from now. If a $2 million gain in the next 12 months would push you into the top IRMAA tier on Medicare, you've just identified the single biggest cost most owners never plan for. That number, not the valuation, is what should decide when you sell. If you found this useful, hit like, subscribe, and turn on notifications for more simple explanations.